Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandes and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers, who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome back to this next episode of Finance This Property That. It's part 2 of our Emerge panel. This is going to be a monthly panel discussion where we take you into, give you a bit of insider knowledge into what's happening in the mortgage market and home buying market. So thanks, Adam, Simo, and Luke for returning.
It's good to be back.
The much requested sequel.
Yeah. You haven't moved from the spot from the last time, but no,
we needed a couple of shirt changes or something
I know.
Change up the enigma.
Hey, look, I thought we'd do our part, our second episode after telling us a bit more about Emerge around the 2025 outlook for home buying. And finance, what's happening, looking at how interest rates are going to impact lending decisions. How do we adapt to changing bank policies, because they're changing quite frequently right now. We've just seen a whole list just come through, and then some tips for securing finance in this current market. Right, I think that's really really key. So I don't know when this will be put out, but February 18th. Is our first RBA meeting for the year. Now, from my understanding, 3 out of the 4 banks are predicting a rate cut.
I think it's 4 now.
It's 4 now, yeah.
It's all 4 now.
NAB actually jumped back on board, predicting a rate cut. Cool. Let's have a little bit of a discussion about, what are your thoughts? And how does it really impact borrowing? Anyone can kick it off.
Go on, Adam.
Look, it's been a really positive start to the year, hasn't it, guys? We've had lots of inquiry, lots of people are looking to get into the market. My personal opinion is I think if rates do decrease, and it looks like they will, I think that'll spur on the market a bit. Property prices are typically pegged against people's ability to borrow and their borrowing capacity. So, most people are, borrowing near their maximum because the banks are quite conservative with their buffering based on the APRA serviceability buffer. So as we see rates come down, it will increase people's borrowing capacity. They've got more ability to, get an extra bedroom or jump into a closer suburb or get a bigger block of land. So I think, and it has been, the confidence in the market was shot a few years ago with the amount of interest rate increases we had. And look, it was really tough as a borrower to be taking on new debt because you didn't really know where the ceiling was going to be. Like we all run our own cash flows and budgets in our own households. And if you're budgeting on $4 or $5 grand a month in a repayment, but then the rates could potentially go up, how do you know where that ends? I think the first rate cut will really just be a catalyst for confidence in the market and saying, okay, well, if I'm going for a loan that's going to be $4,000 or $5,000 a month, this is almost going to be the ceiling. If we get anything else, it's going to be a benefit. So I think it's going to be a really strong, sign for the market. Inflation's pretty much under control. There wasn't the huge cliff, like mortgage fixed rate cliff that everyone was talking about. Everyone just gets on with it, right? Like people are pretty house proud. They tighten up the buckles, they tighten up the budgets, they take on new jobs or, get pay rises and whatnot, or cut out, Netflixes and all sorts of rubbish that people aren't using. They pay their house off first. Like the mortgage payment is almost the first payment that people make in a household. It is, Maslow's hierarchy of needs. It is shelter, security. So, we are very house proud in Australia. So it just hasn't really, yes, we've had some clients that have been impacted, of course. And yes, we've had lots of people whinging about rates over the last few years, and no one likes paying double the amount, but everyone just gets on with it. So yeah, I think that's been a real positive. So yeah, I'm looking forward to this year. I think it'll be a cracker.
I think the market's realigning. I do. A 0.25% decrease if it's all passed on, if and when it's passed on. You can actually see NAB recently dropped their fixed, or they are dropping their fixed rates by 0.25. read the tea leaves there. So they're also, obviously, they're the last ones to jump on board with the rate cut. But, 0.25, when, your assessment rates are still a 3% buffer, because that's what the banks need to still do. There was talk around trying to get them decreased. That's not going to happen. We don't want to put people in more mortgage stress, but yeah, I think it'll be a positive thing if it's dropped. Is it going to be a massive shift in your borrowing capacity? You probably won't see that till probably the third or fourth rate cut. When if it's even we get to a 0.75, that's probably when a total of 0.75 when it's dropped. So I think that's when you're going to see the bigger impact on borrowing capacity. And the one key thing is if the rates drop, I know I'm telling my clients, don't change your repayments.
Yeah.
That's it.
Yeah.
That's the worst thing you can do, because that's where people got caught out. When the rates dropped, they all changed, well, not all of them, but they changed the repayments to match the rate. You're
already
taking
used
longer.
to that repayment, right?
Just pay it. Yeah.
And look, I'm sure a lot of people don't realise how the Reserve Bank uses interest rates to regulate inflation, but effectively what they're trying to do is divert more of your income into paying off debt and less of it into spending
money
on TVs and holidays and going out, right? So I guess, it can have a negative impact when rates drop, because then people feel this weight is lifted off and they've got more money to divert back to other items, right?
Yeah, 100%. What do you guys think?
Yeah. Hit the nail on the head, you two there. I've seen a lot more people look to enter the market at the start of this year. Like, I think last January was quiet-ish. This year in January.
January was dead.
Yeah.
I'll tell you.
In comparison to this January, it's chalk and chease. I think
definitely.
a lot of people are trying to get themselves ready in anticipation of a rate cut and try and pick up something now, because I think if there is a rate cut this month or in the next couple, then that's going to instill a lot of confidence and perhaps add a bit more fuel to the market here in Brisbane. I'm seeing a lot more investors coming and trying to invest in Brisbane or other areas and just trying to leverage a bit more before perhaps a rate cut on the radar.
Yep.
Yeah,
I agree with you guys as well. Like, I was looking at the other day, if rates do come down, they're probably only going to reduce it by 0.25. So
if they pass on the whole amount, right? They may reduce
the banks
cash rate.
might not either, but if they did, then it's only like a 2.5% increase in borrowing, roughly, depending on the bank. And so, I think the biggest thing, similar to what you guys are saying, is they're probably not going to get a massive uplift in borrowing, but their sentiment's certainly going to be a lot more positive, and that at the end of the day often drives a lot of the market, right? So I think, everyone's looking forward to a rate cut. We've been talking about rates for the last 18 months and it hasn't changed. I think everyone's sick of putting the cash rate at the same number when the brokers are uploading their social posts. It's always the cash rate's on hold. So it'd be nice to put a different number.
But how many of those do you see? It's like the same message. It's like, cool.
Exactly.
Just get cracking, paying your home loan off. But like you said, like it only is, if it drops it by 0.25, yes, you're going to save a little bit of interest. If you keep the same repayment, you're going to just pay your loan off quicker.
That's right.
Right? And for an investor, it's going to help your cash flow a little bit, right? I mean, it's maybe only 0.25, but 0.25 is better than nothing.
Yep.
Right? Got to appreciate. And then hopefully people keep their finances in check.
It'll be interesting because we might start seeing more fixed rates as well start happening. I think, we've all spoke about this before, how mainly people are doing variable at the moment, whereas before the rates started going up, we were doing, splits of both a lot of the time. So, it'd be interesting to see what happens.
Hedge your bets either way, right? I mean, because, there's some banks that are aggressively dropping their fixed rates. Yeah. There's some in the low fives, depending on your LVR.
That's right.
But, I mean, like I said, NAB just dropped their fixed rates by 0.25. So that's the lead indicator, right? That the rates are going to drop. They want banks trying to lock you in to probably make up a little bit of that cash as well, because fixed rates are worked differently to variable rates. So the buy swap market's basically the overseas market is the fixed rates, and your variable rates are judged on the cash rate. So they're playing two different markets and hedging two different bets. But it's probably not a bad option for some people that are looking to secure or at least understand their budget, right?
Yes. Yep.
I think we'll see more investors as well, right? Like they have gone out of the market for a little bit just because the cash flow isn't there. Like properties are more likely to be negatively geared and, quite a large amount of negative gearing based on when they bought it. So I think with the rates coming down, it then tips that table a bit more. Investors are probably more likely to get in because it's not actually taking as much out of their pocket every month.
Yep.
But then they've still got the benefit of having another asset in the market, potentially growing.
Yeah, 100%. And like we've just spoken in the last 3 podcasts, it's like, if you're not in the market, you're not making, you're not growing, you don't have an investment, you're not growing. You've got to get in when you can get in. And where you can get in, at the price point you can get in without
be realistic, compromise.
Yep. You don't need the 4-bedroom house in Barton, right? Overlooking the city. If it's your first home. Get a 2-3-bedroom townhouse.
Yep.
Get a 2-bedroom cottage. Do it up, paint it over that period of time. Grow the capital in it.
Yeah.
So that's probably one of the biggest things that I tell. Don't overstretch the budget. Just because rates are going down, just because you can borrow this or potentially borrow it, doesn't mean you need to borrow it.
Yeah.
No,
Look at the bigger picture.
Yeah. And look, banks are changing policies, right? Like they're seeing the borrowing behavior. So classic example last week, a self-employed policy's just changed. A bank that uses 1 year self-employed in isolation, if they're using full extraction now, will require you to have a minimum $200 per month servicing capacity. Can't just have $1 like we used to, right? And it's a pass. So based on the assessment rate, which is usually 3% higher, you still need to be able to service that debt by minimum $200 a month. So I think $2,400 a year is because they can see the volatility in that, right? And they can see as rates go down, people want to borrow more. So that's another indicator. What have you guys seen that's changed?
The one I've been seeing a big difference is short-term employment and also casual employment. So that was an industry of the employment market that got really hammered during COVID. So, a lot of banks used to look at 3 months history and, be happy with that. When COVID hit, it went out to 6 or 12 months. We're starting to see those come back in. And we're also starting to see, a lot of, government, they're on short or long-term contracts, some paid, with or without annual leave, but the banks are just becoming a little bit more flexible around that. So I know, we have a lot of questions from clients around, I've just changed jobs or I'm just about to take a new job. Will this affect my ability to borrow? And in most cases, we do have lenders that can accept that based on deposits. So I think that's a really big positive because typically that's been a big hindrance or people hold back for that. But again, it's just a conversation. Come and have a chat to us. We can look at some lenders. We've got 40 plus lenders on our panel. That's the benefit of a broker. We've got someone that wants to bank with you, right?
And like you said, Simon, all these different policies you can research.
That's it. That's the benefit.
Options. I guess looking back and having the benefit of a team, we can bounce those ideas. Hey, I've got this scenario.
Yeah.
What have you guys heard? Have you guys done the scenario? Because I always look at it if there's a scenario that's come up, it's when was the last time I did this? Who did I do it with? Oh, okay. I may have heard you guys talking about it. Hey, were you guys we had a foreign income guy was like, hey, did you do a foreign income guy recently? And you did it self-employed and stuff. So we found an option, right? So that's the power of the team. What are you guys seeing in policy or how do you guys coach your clients to adapt to changing policy? Or how do you stay on top?
I think the biggest change in policy or probably popularity in policy that we've seen a lot over the last 12 to 24 months is bridging. So a lot of bridging loans, we've seen some banks pull out. We've seen some banks specialize in it even. So a lot of new to bank specializing in bridging. And it's been a really good policy for people who are wanting to upgrade or, move properties and they're living in their current property and still be competitive. Because obviously if you've got an existing property and you're trying to get into another one, you might be purely contingent on selling yours. So, you need to have a policy that lets you do that, excluding the your existing place. So, I think bridging's been a massive one that's been really helpful to a lot of clients get into that home that they want without all the strings attached to selling their place first.
Yeah. And it allows you the power of negotiation, right?
Yeah.
I mean, if you were selling your house and someone said, it's subject to sale of my house, and they're offering you the price you wanted, but then someone offered you 10, 11 grand less, but there was no subject to sale. It was just,
Yeah.
you're going to take that any day of the week, right?
Exactly.
Like, take it. And that's the power of that. And you're right. There have been a couple of new lenders that have come on board. One that purely just does bridging,
Yep.
right?
Yep.
And it's short term. They don't want you there forever. Get in. If there's a residual debt, get out.
Yeah.
Basically.
Yeah, and there's obviously they all calculate it differently, and you know they all kind of suit different clients as well. And so you know there's a few extra fees involved with a lot of them, but again, it comes down to that convenience factor. And if it's going to get you into the property that you want and beat out the competition, then you know it's probably worth it.
It's an awesome solution.
Yeah. Oh, 100%. And, you know, next little talking points around tips for securing finance is obviously get the strategy right. What is your buying and selling? If you're buying and selling at the same time, well, you actually need a clear, definitive plan. It's not just, I'm just going to sell my house for $1 million, then I'm going to look, well, where are you going to live in the interim? Like, are you going to go rent?
Exactly.
How much does the market move between selling and buying,
exactly.
right? I mean, I'm a massive fan of bridging. We're doing a lot of that for clients at the moment. So it really allows clients to buy and sell in the same market so they're not missing out. I mean, we've seen it, like especially post-COVID, properties were going up 20, 30, 40, 50 grand a month. So if you're out of the market for 6 months because you can't get back in, that can be quite costly, right? It also, like, you know, a lot of us have got young families, like it just avoids the requirement to be moving twice. So it's a nightmare packing and moving and changing all your internet bank or all your internets and mobile and, you know, electricity accounts and stuff. So it just allows you to do that in one swoop.
Yep.
And it means that you don't actually have to sell until you've actually committed to buying. So you know it's
Exactly. And going back to your point, like who wants to like actually move on the same day? Like, you know,
Well, and it was actually hard to find rentals too.
Yeah.
So
Correct.
a lot
That's
of the
really
time it
tight
wasn't even
market.
an option either.
Yeah,
Or you're paying a lot for rent.
Correct. And then that's sort of eating away at the savings, right? But also, if you're looking at your buying and selling strategies, they're two separate strategies that need to work together. Wouldn't you want to just move out of your property, no stress, right? You set yourself up in your beautiful new home. Your existing home, you clean that, you stage it.
Get top
Potentially,
dollar. Yeah.
you're getting better money, right? Just for that extra couple of months, 2-3 months. Because bridging's how long's normal bridging? I don't do a lot of it.
You can
so-
usually do 6 or 12
months. But
yeah.
I mean, we're seeing clients doing it in a week or two.
I haven't had one client last that
market
long
is so
yet.
strong
Yeah.
with the sale.
Yeah.
Yeah, and you know the banks do the valuation. They sort of shade the valuation a little bit so that they're within their margins, right? So we know that if that client sells it, like if the valuation comes in at 1 million, the bank's only going to use an $800,000 valuation. There's a bit of a buffer for the banks as well in case it doesn't sell for $1 million.
Yeah.
Right.
Because of those buffers, not everyone can actually qualify for a bridging loan, which is a shame because then you got to look at the other scenario of, you know, subject to sale or putting a long settlement on. and
Simultaneous
try and,
settlement.
line up settlements, which can be a bit of a nightmare, which you mentioned. So
Yeah.
if you do qualify for it, it's an awesome solution. Like we've been able to help so many clients in the last 12 months through this solution. And like you said, they haven't had to bridge for very long at all.
No, that's it.
So yeah, it can be expensive in some cases, but it is a great solution. And it's important, like when you're thinking of buying a new property, is have a chat with your broker early. Discuss what options are available to you because you might think you only have to do a subject to sale or same day settlement. You could save yourself that stress.
Some people don't even have to do bridging. Right? Well, we had classic Nick and Katie. They didn't need to do bridging. It was just you had the servicing, you had the capacity. We could do this. You can then go sell your property, and they did that within minutes. So it's not all like there's that option, but we got in so early to understand the situation, get that pre-approvals done, and then you go just make the offer. Literally, 7-day finance. Or actually, they went to auction, so it's like it's fine. we already knew what they could do.
I mean, there's been clients we've set up bridging for and they've ended up buying with a longer settlement and then they've sold their place before. So then we just like flick it over to a normal loan, but they've still been able to secure that first property and buy it and go under contract and go unconditional without having to have a subject to sale. So there's lots of different scenarios. And I guess, look, we work with clients on those scenarios all day, every day. And so I guess, we want to, it's good to speak early to see what options are available.
It literally comes debt structure strategy.
Yeah.
It's about preparing for the worst and then, making sure we've got all ducks in a
and
row.
I think we're quite lucky in the current market where houses are moving. Well, certain houses and certain areas are moving fairly fast. You know, so you could sort of do we've got all the research that we can do, like how long do houses in this particular suburb of this particular nature stay on the market for. You can potentially do that research and go, well, guys, this is going to sell like pretty quickly. We could do this, and there's so many options you can look at, and it's about the guidance and education, right?
I think the other policy one I was keen to talk about was self-employed.
Yeah.
I reckon it's probably one of the best times ever to be borrowing, or the easiest time to be borrowing as a self-employed client. Like, how many people do you get that come to us that say, oh, it's so hard as self-employed? But I mean, we've seen a lot of really cool changes in policy around self-employed in the last couple of years. You know, we've obviously got the director's wages or the salary policy now, where if a director is paying themselves a wage out of the business, we can just use that as a standard salaried employee and proceed with that way.
Yep.
You know, banks are now ignoring company debts. You know, if they've got equipment or cars or, you know, business loans, some of them can, you know, ignore that, provided the business is, you know, trading profitably. We can do 1 year's financials, which we were talking about before. So, you know, if a business or an industry, you know, again, post-COVID, there's a few that got hammered through COVID, but they're now back up and really kicking butt. We can use that as a more like real expectation of what their profit's going to be.
100%. And and when we're using that sort of stuff, there's other banks that even use the pay slips, the director salary, but some just use 2 years notice of assessments for self-employed, right? You can't add, if there's rental income in that year, you can't add the rental income because it's already been looked at, right? But and that's another great.
But then you've got the full doc, like if people are keeping profits in
Yeah.
entities, or they're distributing it to bucket companies, or, you know, kids or parents or spouses.
Yeah.
So you got that. And then, I mean, barring all of that, we've then got, you know, we had a client recently that picked up a really strong contract, but it, you know, wasn't really, the revenue wasn't showing on a tax return. So, you know, you and I worked on that one as a more of a low doc, where a bank will look at, you know, some BAS or business bank statements or accountant's letters or self-declaration. So, you know, there's a lot of opportunities and options now for self-employed. And the amount of times that we see people that start talking to us and say, oh, I spoke to my bank and they said we couldn't get anything. But then, you know, we all do this constantly and this is our expertise. We look at the financials or work together on the financials, and we can, you know, come up with an option for a client.
Yeah.
So,
like you said, Simone, the last one bank, one policy, one product.
That's right. That's right.
What do you do?
Yeah.
And like, there's so many, like I reckon there are more options. They're actually not I reckon. There are way more options to borrow as a self-employed.
Definitely.
As if you're self-employed, than there are PAYG, right? There's payslip. Like that's it. Like everyone does a payslip, but everyone does it differently. It's just the same as the self-employed. Like, you know, the low doc stuff, just we can use 12 months BAS or the first half year's BAS, right? There's 1 year, like 1 year in isolation, all those policies, but it's about what fits. I'm doing one at the moment where we're just using BAS, and we don't need an accountant letter to sign off because accountants are very, what's the word?
Apprehensive.
Apprehensive. Yeah, you know, they're getting a bit of
cautious.
pushback.
They're cautious.
Their
which
bodies
is
and things,
which is fair. Like everyone's got to look after their own businesses. And I've got a lot of, and it's about educating accountants too. Like, you're not actually doing this is what this actually says. But yeah, you're right.
And look, we're all self-employed, right? Like,
Yeah, I
I don't submit my tax return on the 1st of July every year. Like, there's always a delay in getting it done with accountants and things. So even though it might have been a good year, I mean, what do you got to show if the tax return is not done? So I think that's where a lot of these other policies are really coming in. And I'm certainly not the only self-employed person that doesn't submit my tax return on the 1st of July.
No.
You know, they're not due till May if you're going through an accountant.
Yeah, correct.
March, April, May. So, you know, there can sometimes be a 6, 7, 8 month lag in those numbers. So it's really cool to see some of these lenders coming out with, okay, well, no, we'll take your BAS from this quarter or last quarter. Like, that to me is a more real representation of what that business is trading.
It's ongoing is what's going on. And, you know, there's a lot of some lenders will even use draft financials as well.
Yeah, correct.
Here's the draft financials supported by an accountant's letter. We need more information. Here's the BAS for the current financial year, and this is how we're trading. It's in line. We create the story because our job is to get the deals approved, like get you approved safely, meet your requirements and obligations, and put you with the bank that actually meets it. Because we can talk about price and rate all we want, but really before we even look at that, does the rate, like if you've got a 2% rate here, but you can't actually get the policy,
Yeah.
it's irrelevant.
Yep.
Well, especially like if the market is moving quick and if you can get into the market sooner with just using your BAS statements for 6 months or, whatever the policy ends up being, then, you're in the market. It's a short-term solution until your tax returns get done. And then you can go to another lender, maybe get a better rate or something that suits
I'm
you.
about to have another conversation with a client now. We did alt doc to get her into her property under a trust. Now she's done her 24s and now we've got BAS and the 24s look awesome. Now we've got 6 months BAS. I can use the 24s in isolation now. And we've moved from like 7.39 to probably 6.5%.
Yeah, exactly.
But that's a strategy. We planned that out right from the beginning.
Exactly.
And she's been patient. So obviously, yeah, cool. We can pull the trigger, get me the BAS. So
And look, it's not set and forget, right? So like a lot of ours, we're very active with our, reviews and talking to clients post-settlement, contacting them with pricing and things like that. So, that comes into it is the review around, is this lender still appropriate for you based on what we went in with, or is there a better option now that you do have some more tax returns or something? So, yeah, I'm really excited about self-employed this year. I reckon it'll be a cracker for that. And I guess it just is a conversation, right? Like if you're self-employed out there and you're being told this is your borrowing capacity, it's always worth a second opinion. We had one a couple of, probably 12 months ago where they went to their bank, got told they could borrow nothing. We looked at it and we got them approved for $1 million beach house down the coast. It's probably now worth 1.5. So, there's an opportunity cost there, like you were saying, Simon, about not borrowing. And look, that wasn't reckless borrowing. It was all within bank policy. And the person at the bank just didn't know how to read financials, whereas we've all got the experience of being able to do that through our own structures and a lot of the clients that we work with. So,
And I love self-employed. That's my specialty. I love it. Like it's just easy because you can't. They're the numbers, man. Like you've logged that to the ATO, or you've got an accountant verifying that. Like you can't make that up. You can't make the BAS statements up, right? I've seen some very dodgy pay slips, like I'm sure we all have. But yeah, you're right. Like it's just the power of asking, and get another opinion.
Yeah.
There's just always that preconceived idea that, self-employed is difficult, but it's really good to see the banks, being open for that type of business now.
Yep. So. And you had a client recently, right? Like we're working through that self-employed scenario together.
Yep.
And you're just like, oh yeah, now it sort of makes sense. I see how we can actually, there's a way forward.
Yeah, there's so many different avenues, right?
Yeah.
So yeah, your regular broker perhaps may not know, or if you're going to the bank directly, they may not have that solution for you. And one bank, one policy. Like if you're, say for example, a registered nurse eligible for an LMI waiver, and you bank at the yellow bank, they're not going to tell you the red bank down the road is going to save you lender's mortgage insurance.
They don't work for you.
No, exactly.
They work for
So,
themselves.
that's the beauty of us brokers, is that we've got that panel, got the options, the solutions. The policy that I was keen to chat about is investment lending. So there are some lenders out there that are changing the way that they review your serviceability. They'll put in a 1% buffer instead of a 3% buffer when you're looking to do investment lending.
You just had a client like that.
Yeah, so I've got a couple where I'm actually being able to provide a solution. It's where they will do a 1% buffer instead of 3% on top of the rate that they give you. And then they can also, whether it suits your circumstances or not, instead of doing a 30-year loan term, they'll actually go up to 40. So if it suits you and your stage and exit strategy, etc., well, then that could obviously help bump up borrowing capacity by a significant amount versus perhaps lenders that don't offer that.
And also, as an investor, improve cash flow.
Yeah.
Potentially.
Yeah.
If it's the right thing.
Yeah, correct. And the rate's competitive too. It's not like, 7.5%, 8%. It's high sixes.
Yeah, but how long are you going to be in that loan
Correct.
for, right? It's the strategy that you've placed. It's not about it's not about the immediate. It's like, well, let's think 2 steps down the track. Yeah. You've had some self-employed ones come up too, eh?
Yeah.
Like recently.
quite
We're
a
seeing
lot of
more
it.
and more of it.
Yeah, I think there is. And I think it is just comes off the back of all the banks do treat it completely different. And there are a lot of options out there. So I think, it's a really big policy, I think.
It's good. Yeah, we all collaborate quite well together around that. When it's tricky, it's always good to have a second set of eyes looking at it. And before we submit the application, I hate surprises. It's like, oh, I didn't pick that up. It's like, you can just go, oh, geez, yeah, that's right. No, I forgot about that. Explain that. Explain this. Because if we're asking the question, then a credit officer's probably going to ask the question,
correct.
right, as well.
Probably lends itself to the hot topic as well about trust lending. How obviously
I was
that's
about
been
to just jump in.
quite the flavour. I'll let you take the reins.
Well, because there's a lender out there that so currently at the moment there's a lot of lenders pulling away from trust lending, right? They don't want it's the perception that it's harder, just a different structure. That's all that it is. But long and short of it, they just don't want to do it. But there are some lenders that do it really well, price it really well, policies are really good, and they just take a broader lens. Hell, there's one lender that's just changed their policy to say that, hey, look, if there's a trust lending with us and you do another lend with us, as long as that as long as it's looking after itself and you're declaring that it looks after itself, we won't include the liability in it. As long as there's no income from other entities going into that to prop it up if it's making a loss. That's huge when you're building a portfolio, right? And the rates are standard rate. There's no loading on the rates.
Exactly.
But my biggest tip to anyone, though, is if you're setting up trusts and the structures, speak to, like if you're doing it with me, at least speak to me first, because you need to set up, the appointers is one of the biggest things, because they're the ones that control the trust, not the beneficiary. It's the appointers. They can't be third parties. And also the beneficial shareholders, if you've got a trustee company, the beneficial shareholders need to be, in most cases, especially with this lender that I was talking about, need to be individual and beneficially held.
And look, we can't give accounting advice, but I guess we can give a client an idea about what a lender would be looking for with that structure, right?
Yep. And I usually will get on the phone with an accountant and the client and just go, oh, hey, this is the policy. You guys now have a discussion about the best way to structure it. If you don't want to structure it that way, we have to look at another option. And that's fine. That's where they need to get the advice. That's what they pay their accountants for. Cool. Guys, give us your one hot tip for 2025 for securing finance in this competitive market. Luke, give us your tip. You probably had the longest to think about it, because I told you before this is what
Better be good.
Well, look, my tip probably seems pretty basic to you guys, but like if you're looking to enter the market, have a chat with the mortgage broker. Obviously we're mortgage brokers. I like to think that we're really approachable. We're not scary. We're not going to be judgmental about your position at all. We're just here to help you. So if you're looking to get into the market, have a chat with an experienced mortgage broker and work out what your options are. If you're a first home buyer, what incentives you're eligible for, because that's going to make a big difference, not only initially but long term. Work out what that game plan is. They can let you know where you're at, what you need to do to get to where you need to be or want to be.
It doesn't cost you to have a conversation.
It doesn't cost a cent.
Simo?
So I reckon my hot tip will be to look beyond the interest rate. So interest rate isn't always going to be the most important factor when you're getting your home loan. So especially if we do see the market getting more and more competitive, you're going to have to be putting tighter conditions on your offers in order to secure it. And you might have a really good interest rate with one bank, but if their turnaround time is going to be 3 weeks, then you're probably going to miss out on the property. So for the sake of paying a little bit more on your interest rate, it might it'll basically benefit you in the long run, because it means you'll actually get into the market. So
cool.
I'm always a big fan of the pre-approval. It's always good just to get that sorted, get it out of the way. It's a really great way. And obviously through a broker, the majority of the pre-approvals that we get are what they call fully assessed. So they will actually go to a credit team to be looked at and assessed and judged, and they'll come back with any issues or questions. So it just gives you a really good idea about what your budget is, gives you the confidence to go out and start shopping, and it gives you a little bit more strength when you're putting in offers and talking to agents around your offer to say, hey, yeah, I'm pre-approved with a broker. I'm good to go. I'm not a time waster, not a tire kicker. I mean, it's, we get it all the time. It's amazing how many people just ring us and say, yeah, I've signed a contract, and they haven't had any conversation with anyone. And look, we're always still happy to help, but a lot of the time it's a lot easier just to get your ducks lined up early on and get it ready. A pre-approval lasts for 3 months, and in most cases we can extend it for another 3 months. So really, you've got 6 months of runway to have a crack and get into something. So
Yep. And I think, just touching on your pre-approval one there, you, as a collective, we've got such a good standing with a lot of the banks that not every broker gets a fully assessed pre-approval, right? And the power of fully assessed pre-approval means that you literally, as long as the security is good, that's all, security and valuation, that's all we need to worry about in that 90-day period, and as long as your situation hasn't changed, right?
Yeah, correct. And that's another misconception. So a pre-approval will approve you and your income and your deposit and your credit worthiness. They'll do a credit check, but doesn't approve the property, right? Because that's still the unknown. So effectively, that's as far as we can go, even when clients are going to auction and whatnot, is getting them sorted. Obviously, the bank's got to still be happy with the security too.
Yep. And that's the conversation you'd have up front, where you're actually looking what you're doing. The other one is if it's in lender's mortgage insurance territory, you probably want to get a pre-approval.
Yeah, correct.
For that as well. Look, again, I'll just jump
What's your
off.
tip, mate?
What's yours?
Mate, my tip is
Don't leave us hanging.
my tip is be organised. If you wanna build in 2025, have a clear strategy on what you want to do, have a team around you, and not a team of yes people. You need to have teams that are like that. They do their part really well and they don't muddy the waters. So I do the finance. We have someone like a Chris McNulty that does the property purchasing, right? It's the buyer's agent. You have your Natalie from JHK Legal. They'll do the conveyancing. You've got property managers like Michelle Watt. They'll look after. We don't get involved in what other people do, right? That's separate conversations. But be organised. Have the team around you. That's how you build a great portfolio. And don't rush. Go slow to go fast. Because it's
There it is.
so I've got to get it in there.
Last one.
That is my tip. But guys, thanks again for joining in part 2, it's been amazing. Plug your little Instagram pages again, Simo, because we've got to get your social media manager.
Simon.mortgagebroker on Insta and TikTok, guys.
Find them.
Luke Ashby, mortgage broker on all your social media platforms.
Just blanket Emerge Finance. Everywhere.
At Dion Finance Specialist on Instagram. You'll find me on LinkedIn as well, and Facebook. It doesn't cost anything for you guys to follow us. If you guys have got any information or learned something, share it. Doesn't cost you anything. Share the podcast, follow the podcast. It's free information. That's why we do it. We do really love what we do. If you want to have a chat, jump on our socials, send us a message, book a time, jump on the Emerge Finance website, www.emergefinance.com.au, book a time, have a chat. And we talked about a lot of stuff, including policy and our thoughts on rates and securing finance. It is very general in nature. So it's not tailored specific advice. If you want specific advice on your current situation, come and chat to one of us or whoever your trusted advisor is. Apart from that, guys, see you on the next episode.
Thanks, mate.
Thank you.
Done.
Thanks, mate.